If you have an income of more than 5 lakh rupee, then you need to pay tax. But you can still save your income tax by investing money in various instruments. If your taxable income is more than 5 lakh and you haven't invested in FY 19-20, then you should invest now. If you have already invested for tax saving for previous year, then you must be thinking where to invest for current year, which is FY 2021. And you must be thinking what is the maximum tax you can save. What are the best options to invest and save tax? So let's investigate further and see what options we have. Hi, my name is Sahil and this is my Personal Finance Academy where I explain money management in layman's language. In this video, I am going to analyze 8 options of investment which can be used to reduce your taxable income by 1.5 lakh under Section 80C. The 8th option is my personal favorite, so please watch this video till the end. How much tax you can save? If your taxable income is more than 10 lakh rupee and you fall under 30% tax bracket, then you can save a maximum of rupees 46,800 per year. How did I calculate rupees 46,800? 30% of 1.5 lakh is rupees 45,000. So let's say if your income is rupees 12 lakh, then you can declare investment up to 1.5 lakh to save 45,000. Now there's an education cess of 4% on top of your income tax of rupees 45,000. So 4% of 45,000 is rupees 1800. Add this education cess of rupees 1800 to the 45,000 tax and your total income tax become 46,800 rupees. Likewise, if your income is in between rupees 5 lakh and 10 lakh, then you fall under 20% tax bracket, and in this category you can save a maximum tax up to 31,200 rupees under Section 80C. So let's discuss how to save tax under Section 80C and what are the options with their pros and cons. Number 1 option is tax saving FD. These are specific FDs which fall under tax saving category. One of the advantage of tax saving FD is your fixed return. You get a fixed annual return without any volatility. This gives a peace of mind to someone who is risk averse and do not want any volatility in the return. If we talk about the disadvantage, then one of the disadvantages is low return. The returns are in the range of 5.5% to 7% depending upon the bank. These tax saving FDs have a lock-in period of 5 years. It means you cannot take out your investment up to 5 years from the date of deposit. Next disadvantage of tax saving FD is that your interest earned is taxable. It means although you can save tax up to 1.5 lakh, but the interest you will earn on your investment would be taxable. So for example, if you get an interest of 6% on FD and if you fall under 30% tax bracket, then your effective interest post-tax would be just 4.2%. My review is it is not a great option, mainly because the return rate are low and it has got a lock-in period of 5 years and the returns are all taxable. However, if you still want to see what all options are there for tax saving FD, you can just Google it and you will get all the options. Next option to reduce income tax up to 1.5 lakh under Section 80C is PPF, which is your Public Provident Fund. You also call it PF. Again, one of the advantage of PF is fixed return. Your returns are fixed and they are not volatile. Next biggest advantage of PF is your exempt status. So the first exempt means that you can reduce your taxable income up to 1.5 lakh under Section 80C. So if you fall under 20% tax bracket, you can save tax up to rupees 31,200, and if you fall under 30% tax bracket, then you can save a tax up to rupees 46,800. Next exempt means that your interest earned on the investment is also exempted from tax. Unlike fixed deposit FD, if you invest in PF, then you don't need to pay any tax on your interest. The current interest rate on PF is 7.1%. Till last year, the interest rate was 8%, but it is now reduced to 7.1%. It means if you invest, let's say rupees 1 lakh in your PF and you get a return of rupees 7,100 by end of year, then you don't need to pay any tax on this return. If you had opted for tax saving FD, you had to pay tax on your returns. Final exempt means that when you withdraw money from your investment, you don't need to pay any tax on the withdrawal amount. Let's say you invest in PF every year and eventually build a corpus of rupees 50 lakh, and when you withdraw this 50 lakh rupee, you don't need to pay any tax. One of the biggest disadvantage of PF is a lock-in period of 15 years. It means you can't take out money for the 15 years from the date of investment, but partial withdrawal is allowed after 7 years. So my review is that the interest rate of 7.1% is average, although better than FD, but the biggest advantage is that the interest earned is tax-free, which makes it a good option of investment. However, the lock-in period is too long. Overall, a small portion can be kept in PF. Third option is EPF, which is your Employee Provident Fund. This option is applicable only for salaried employees. The total deduction in EPF is your 12% of basic salary plus DA. The return rate is 8.5% and the interest earned is tax-free if withdrawn after 5 years of continuous service in a company. My review is it is a good option to save tax. However, there is a limit on investment up to 12% of your basic salary plus DA. Hence, it is difficult to consume your entire limit of 1.5 lakh. Next option is repayment of home loan. Principal from your home loan can be used for deduction up to 1.5 lakh under your Section 80C. This deduction is also applicable on stamp fee, registration and transfer fee. My review is that if you have a home loan, then you should use this to get exemption under 80C. Next option to save tax under 80C is payment of your children tuition fee. Children tuition fee can be shown for tax deduction up to 1.5 lakh under Section 80C. My review is that if you are paying for your children tuition fee, then you should use this option to get tax deduction up to 1.5 lakh. The sixth option is National Pension Scheme or NPS. This is an initiative from Indian government to provide a pension facility to people working in unorganized sector and private companies. There is no limit on the investment, but you can save a maximum tax up to 1.5 lakh. Additionally, individuals can claim an additional benefit of Rs 50,000 under Section 80CCD. Hence, you can use NPS to make a total deduction up to Rs 2 lakh. Please note that the returns from your NPS are not fixed. They vary in the range of 8 to 12% based on the various categories of NPS. But one of the biggest disadvantages is that it has a lock-in period till your retirement. So the retirement age is 60, which means that if you are, let's say, 35-year-old, then you need to wait for next 25 years till retirement. Next issue is that you can't take out entire money at retirement. You can only withdraw up to 60% from your retirement amount. Next 40% would be paid as monthly pension. One advantage is that when you withdraw 60% of money on retirement, you don't need to pay any tax on this 60% retirement fund. My review is that it is a very good option to build a pension fund with investment in relatively safer options and a better return. The best part is additional saving of Rs 50,000 under Section 80CCD. The only drawback is a long waiting period. I'll create a separate video in the future explaining NPS in detail. The seventh option is your endowment plan and ULIP plans. These are the insurance cum investment options. Endowment plan returns are fixed and ULIP plan returns are variable. The problem with ULIP and endowment plan is the returns are very low. They have high commission charges and even the liquidity is low. My review is stay away from these plans. I have already explained in my previous video why you should never mix investment and insurance. You should always take a term plan for life insurance and a medical plan for medical emergency. Eighth and the final option, which is my personal favorite, is your ELSS, which is your Equity Linked Savings Scheme. It is a category in mutual fund which allows a tax deduction up to 1.5 lakh under Section 80C. The lock-in period of this category is just 3 years. If you talk about the returns would vary based on the market condition. But historically, they have given a return of more than 10% when you withdraw at right time. Currently, the markets are down and hence the return are low. But for the long term, ELSS is the best investment option. If we talk about taxation, the tax on ELSS is very low. There is only a 10% income tax on the profit more than 1 lakh. For example, let's say you invested Rs 10 lakh over a period of time and you got a return of 15 lakh. In that case, your profit is Rs 5 lakh. Now the tax is 10% on profit over and above 1 lakh. In this case, the profit over and above 1 lakh is 4 lakh. So the 10% of 4 lakh is 40,000. So on your 5 lakh of profit, you will end up paying a tax of Rs 40,000. Now let's look at some of the best ELSS options available for investment. Just open Money Control website. On this, click on mutual fund. Just scroll down. Here you have an option of tax saving. Just click on that. Now you have an option of ELSS. Just click on that. If you scroll down, you can see the list of all the schemes providing ELSS option. Just sorted by asset under management. You can see Axis Long-Term Equity Fund has a asset under management of 19,126 crore. Now if you look at the return of 1 year, it is showing a negative 5% and 2 year is just 2%. So someone who is willing to invest in ELSS would be thinking why to invest when the returns are negative. But the reason for negative return is due to the current fall in the market. If you click on Axis Long-Term Equity Fund and if you scroll down, you have an option of return. Just click on that. If you scroll down, you can see the annual return from this fund. So you can see here in 2016, Axis ELSS has given a negative return of 0.14%. However, in 2017, Axis ELSS has given a return of 38.99%. In 2018, again a positive return of 4.32%. In 2019, the return is 16.41%. But due to the current market fall in 2020, the return is minus 10.58%. So you can see the returns vary every year, where you even get negative return, but when you get good return, the returns are as high as 38.99%. So in the long run, the average return from the ELSS mutual fund would be more than 10% when you withdraw at right time. If you take my review, ELSS is the best option to invest and save tax under Section 80C. I personally invest all my money in ELSS mutual fund after EPF deduction. How to invest in ELSS fund? You can either invest directly by opening account with any of the mutual fund house where you want to invest, or you can open an account with any of the zero brokerage firm where you can invest directly.